Welcome to an emergency edition of the Grey Market Talk. We're recording that during the week because we're both very active on Sundays, not together, even though I would love to spend more time with Nick. But we thought we'll talk about something that happened last week, and that is obviously the Bank of Japan doing shenanigans in the market. And as I am just a humble equity options trader and don't have a clue about currencies and bonds, but Nick has, and he traded that stuff his whole career, I thought I might ask some question which some of you might find intelligent, others might not, but I have to ask these questions. So thank you for having the time, Nick, to do that during the week, that we can actually please our audience on a Sunday.
You're welcome. It means that I can play some golf on Sunday then.
Oh, lovely. So I shall be in England and visit family, have a good time. Anyway, Bank of Japan, that is something we spared out on our last Grey Market Talk because I thought it was actually quite interesting. So what happened? I call this an explainer because I will go a little bit back to explain that to my students. Yield curve control. What is yield curve control? Well, what is a yield curve? Yield curve is simply if you borrow somebody money for 3 months, a year, 2 years, 5 years, 10 years, 30 years, 100 years in the future, they all have different interest rates because they represent credit risk and general market conditions, and the market will price this beautiful curve in there. You have your part of the curve already. And yield curve control is simply what central banks might do. Some don't, some banks don't do it, obviously. They're only active in the front end. And then there are, well, what do you want to call it? Sophisticated, Nick? Are the Japanese guys sophisticated in their yield curve control? They want to control the whole strip, yeah? From 0 days till 10 years. And that's what they've done now, more or less successful, depending on how you measure success for the last, when did they start? In 2017, when they put in a target?
That was the yield curve control started in 16.
Yeah. 16, yeah. So I got that right. So Nick, are they clever doing that? Are they achieving the purpose they want to achieve? And what is that purpose actually?
Well, so that is actually the real question. What's the point of all of this stuff? And I guess this comes from the, the Abenomics at the time, the decision in, I think it was 2013 or so, from Kuroda, who was the Bank of Japan governor at the time, to basically implement, super duper quantitative easing and quantitative easing. And at the end of the day, what that was supposed to do was to reinvigorate the big bazooka, the Japanese economy, which had been for many years just sort of dwindling, and when debt was growing at the time. So they came up with a plan. And if you think that plan was 10 years ago, and 10 years later, we now look at the Nikkei is starting to come under some international investment focus, whereas for years it hadn't, right? We see some growth coming into Japan. We see some semblance of inflation coming into Japan, which is good inflation for them. So you might say that this is actually part of a long-term story, which is showing signs of the green shoots of success. There is a new Bank of Japan governor now, Ueda, and this policy of yield curve control is, you and I talked about this a couple of weeks back when we talked about, well, what do we think of the US Treasury market?
Yeah.
Surely isn't it a great purchase right now because you got yields at 4% or so, and if things don't turn out so great, then yields are going to come down. And my philosophy on that was, I think the only way out of the problem of super debt from sovereign states is to cap yields. Now, Japan has got the mother of all debts, and that's what they've been doing. They've been capping yields. So, you must think, firstly, is yield curve control about inflation, creating inflation, or is it about keeping the sovereign solvent? And in a world where you've got very high sovereign debt, you have something called fiscal dominance. So every decision you take as a central bank has to do with keeping your sovereign solvent. And in this respect, it's the other side of their policy, which is probably the real side of their policy, is to keep Japan going. And they've done that.
So they achieved their purpose. They kept interest rate at extremely low levels so that the state could refinance itself at what you always preach, at reasonable levels, and wouldn't run into danger running out of money or being dominated by evil speculators in the market.
Well, they are dominated by evil speculators, and I've known people who they call it the widow trade, short and JGBs. Right?
I wanted to ask that later at the show, but explain it to me. What is the bloody Widowmaker? I've read that so many times now. Am I yen short or am I yen long? What am I doing in the Widowmaker? What I'm doing wrong, obviously, if it has this name.
Okay, basically, what used to happen in the 90s was people used to come into the office and say, well, where's the JGB yield? Oh, that's really low. I think I'm going to sell that. And of course, that never made money for them. And they always lost money. And that was called the Widowmaker because you always lost money on such a trade. And forever, people have been shorting the JGB. And of course, now look at it. You know, you have a yield of what today, sort of close to 60 base points or 50 base points or something like that as a 10-year. Imagine where this trade started in the early 90s, where people thought, oh no, that's a ridiculous yield. Surely I need to sell those bonds and the yields are going to go. They never did for years and years and years. And when you think about it, what is the problem of the US is exactly the same as the problem of Japan. They got sort of huge deficits every year, 6% of GDP or something like this of that order, and huge debts from the past. And those things are growing and, you know, they have an aging economy. So how have they decided to handle that? For the first time, actually, when you think about it, for the first time, you've got inflation actually reducing net your debt. So isn't that, as a sovereign, a good thing? But they can't say, actually, the reason we're doing this is to keep the sovereign solvent and so that we can financially repress our investors. So they've been doing this sort of gradually over many years, and it's showing signs of success. But what you saw from the policy statement, obviously they linked in, you know, our expectation of 2% CPI is not there quite. So therefore we have to continue with quantitative easing, which is what they're doing. And that's their goal. They sort of, they throw in CPI as like the story, but behind that, the truth is what they need to do and what they want to do is to keep yields as low as possible, so that the sovereign can continue on and gradually inflation will reduce their debts.
They do have, I checked that up earlier, they do have the highest debt to GDP ratio of all civilized countries, 251 I have here. Does that sound correct? That
sounds about right, 250, 260. I think I've seen 260 something on one of the papers. So whatever it is, it's bloody higher, but it's all in the family.
That is actually a very interesting point. I obviously looked up who owns all that stuff. 50% of that debt is owned by the Bank of Japan. Okay, fine. And then you have pension funds and insurance companies, all domestic. And then there's a little box that says foreigners, 6.7%. So now my question to you, Nick, if you own that stuff yourself, it's like if I borrow $100 from my daughter and then she borrows $100 from me, couldn't we just call it quits and reduce our debt ratio from 250% to 125 by simply saying, well, we have these bonds, we owe these bonds, let's cancel them out?
Yes, or you could just sort of keep them on a ledger between the two of you, and nobody is the wiser. That at the end of the day, or to the outside world, you have very large outstanding debt. But reality is, as it's all in the family, the central bank, the Bank of Japan is not like the Fed, although the Fed is actually working with the Treasury, but they don't make it so obvious. So the Bank of Japan is not as independent and is effectively a long arm of the government, and they're keeping things going. So, but
they could start calling it a Sondervermögen, couldn't they?
Now, yes, that's obviously an inside joke. If you're German, yes, indeed, that's exactly right. But I mean, what you just suggested, I actually suggested at a conference 5 years ago, and I was ripped to shreds by the host, big investment bank, and I was on the podium, and I said, well, actually, why don't they just do that? And he said, do you know where the yen is going to be if they did that? And he is possibly right, and therefore maybe they don't do that. Maybe they just keep it between them, the two of them, And therefore, maybe things aren't so bad for the Japanese, and maybe things are much worse when you, as a sovereign state, are reliant on international investors to continue to fund your debt. And then you have to go through this pretense of you are an independent central bank. At the end of the day, when your inflation is lower than your interest rates for a long time, your debt is just going to continue to explode higher. And that's also not a sensible stance for very long.
Let me ask you the question of an equity trader, because now they had this big thing. Okay, the target rate used to be 0.5%, and now it's 1% on the 10-year end. And they don't
not quite, but we'll talk about that. We'll go into the details. Yeah.
So, and the pundits all over the place are discussing, this could have magnificent consequences for the market, because the Japanese are the biggest US Treasury holders and the biggest Dutch guilders holder and the biggest, I don't know what, the whole of Europe. So they own all this stuff, and they could now start selling it and buying their own bonds. And I thought to myself, well, big thing. You offer 0.5, and maybe now we're going to 0.6, 0.7. Yeah, sure. But 2 years treasuries in the United States bring you almost 5. Why on earth would you say that suddenly makes Japanese debt very attractive to own for domestic people?
Yeah, I mean, this was a view that I put forward to my clients last year. My belief was that that was at the time when the yen was, I won't say falling apart, but it was selling off much faster than other currencies were against the dollar. And the strong dollar was very bad for the allies of the US. And so the question was, is the policy of what was going on in the States actually a good policy for their allies? Because their allies were having to pay for expensive oil in expensive dollars. So the only thing they could do is then to go and sell some stuff. And of course, Japan and Germany, who import a lot of oil and energy in expensive dollars, in an expensive commodity, what do they have to do? As they've been exporters of capital, then they go and sell some stuff. And they say, okay, well, then we sell the stuff, we get some dollars, we sell the dollars, and then we go and reinvest into Japan. So firstly, this is, given that you have assets to sell, this was not such a bad thing. Firstly, and you asked the question rightly. Well, hang on a minute. At the time last year, I think the rates were 0.25%. And why would you buy something 0.25% and not buy something which at the time was about 4.5% or 4%? I think it was in the States at the time. Well, it's very simple, because the insurance companies hedge their treasury holdings. So net, actually, they were having negative returns on their US holdings. And so what that meant was actually 0.25% was better than negative, right? So from this perspective, it made a lot of sense at the time, because they don't like to run just naked, I'll go and buy some treasuries and whatever happens to the dollar, I don't care. Well, they do care. So they go and do some FX transactions. And when the cost of these FX transactions exceed the coupon on the investments, then I have to think twice. Is this a temporary thing, or should I just basically close, my asset, close the hedges, and basically go and buy some stuff internally? And that could, and at the time it did make a lot of sense. And just the threat of the fact that these life insurance companies or these big pension funds were able to do that was possibly enough to keep a lid on the dollar yen. So the dollar yen peaked around 150, 155, somewhere there, and then started to come back down again. And the real question is what happens from here? And that threat is still there.
So to understand you, that I actually get my head around it. So the Japanese insurance companies did a useful reverse Widowmaker, and that makes sense for them.
Yeah, especially when one side of the investment, is starting. It used to make decent returns. I mean, when Japan was paying very low interest rates, and you had higher interest rates in the States or in Europe, and you could hedge yourself and have a net sort of much higher than JGBs, then obviously it's been making a lot of sense for them. But in the current circumstances, these hedge returns don't make a lot of sense for them. So the question is, do they run it, take the loss and say, I wait, ride this thing out? Or do they basically say, actually, you know what? Now that the Nikkei for the first time, and it really was. So when I talked about it last year, the Nikkei was still around 20 small thousand or mid 20,000s. And for a lot of the domestics, that actually would have made a lot of sense to actually say, you know what, I own, I don't know what, S&P, or I own treasuries. I'm going to sell that stuff because actually there's a fire under the Nikkei at the moment. And, they've been fairly right to do so. And the question is, what happens from here? Because we are now all here. And the Bank of Japan have been doing something, and everyone says, well, what is that? Are you raising rates? Are you not raising rates? Because if you're raising rates, in theory, you're making it even more attractive for these Japanese institutional investors to liquidate overseas assets like German government bonds or whatever that might be, US government bonds, and repatriate that money, back into Japan. And maybe that might make a lot of sense for these guys at some stage. And obviously, there's a lot of factors that drive this thing: long-term view on the yen, long-term view on other currencies, long-term view on local asset markets versus international markets.
Let me throw two more figures at you, because obviously I was looking into some numbers earlier to sound as if I actually did my homework.
Glad you did.
80% of all Japanese ETFs are owned by the Bank of Japan. I couldn't believe that number, 80, which means they own about 6 to 7% of the whole Japanese stock market in the Bank of Japan.
Good for them. That number that does sound about right.
So what implication would that have if they raise the interest rates? And the purpose is clearly, well, that is the question we haven't answered yet. What is actually the purpose of what they've just done now, this corridor from 0.5 to almost 1%? What do they want to achieve with that? We've just established, yes, they want to keep money cheap, that the state doesn't run out of money. That's their main interest in there. So why start introducing, I don't want to call it volatility, because they said they wanted to achieve the complete opposite, which I didn't completely understand. But let's take it at face value. What is the purpose to suddenly start fiddling around at the long end with these strange corridor? Is that people, I don't know, to take safety out of the market against the speculators, or why do you do that?
So the policy. So may I first give someone a plug, because there's been a lot of analysts and views from Wall Street and newspapers and YouTube and whatever. Everyone's got different opinion on what this thing is, and I think the most sensible kind of viewpoint that I've heard so far is from a chap called Weston Nakamura, who's a Japanese national, and he knows his stuff. And if in doubt, I always check with him on what's going on in Japan. And his view makes the most sense, which effectively is, since 2016, basically the Bank of Japan began by saying, we're going to keep interest rates around zero. And they never said the band, right? They never said what the upper or the lower band was. And, JGBs were trading around, and suddenly the rates got to 10 basis points. Wow. In the 10-year, and the Bank of Japan just said, mine, your size is my size. They did a fixed rate operation at 10 basis points, and suddenly the market knew, that's your level there. So that level became the theoretical band. It wasn't an official band. It was just the theoretical band. And over time, the Japanese, when you started to go back up, the Japanese authorities, Bank of Japan, introduced a 20 basis point band. And the problem with these bands is, like all of the, when you fix your currency, to the dollar or something, what happened with the Asian financial crisis, if you fix your currency to something and you don't really have the reserve to back it up, and you say, well, I'm trying to sort of fix it to something, speculators will have a go at you. And, the Bank of Japan would test it, bang, bang, bang. Then they moved it to 25, and that level was tested. And then they moved it to 50. And you can see the volume of transactions that took place at 50 basis points. The Bank of Japan basically were, what they were doing was they were taking shots from the market. So if you were a Bank of Japan governor, you've been beaten up every single day by the market. You were having to stand there and just buy stuff because people were throwing stuff at you because they said, you know what, there is no Widowmaker trade here. This time I'm going to make some money on this thing because the yields are going up, because in the States yields are going up. So therefore, and everywhere they're going up and inflation is running away. So surely this is the time for it. So everyone took pot shots at the Bank of Japan every single day.
But it's one of the first rules on the trading floor. You don't announce your iceberg order.
Right. Well, here you go. Well, that's exactly the point. And I think this is exactly what the new governor with his people has kind of figured out, that, if they're going to, I won't say con the market into this, we're doing this for a CPI, and rather they want to sort of say, yes, we are, this is a sensible evolution of our policy, but we want to be much more flexible in our policy. They basically say the 50 basis point stays there. There is a fixed level of 1% where we will definitely act. But between 50 and that level of 1%, we stop being a target and we start being a sniper. So you can't attack us because you don't know where we are. We're not going to tell you where we are. Today we might be at 60. Tomorrow we might be at 65. You just don't know. So we're going to take pot shots at you. Dare you try to threaten this level? And this way, they can basically stick a yield there, 1%, and then hopefully, we don't know if it works. Hopefully, they can say, okay, we've now taken control of our monetary policy. We're no longer being attacked by the speculators. So now we can just get on with what we're doing, what else they would do, and go and buy some more ETFs or something like that.
But I think that there is a difference between being the Bank of England, who is being tested on their pens when the country is actually broke, or the Bank of Japan with all these assets on their balance sheets, who actually has ammunition ad infinitum available. What I like is the idea about it when we spoke about the icebreaker. So if I want to short JGBs now, because I think, well, at the moment we're trading at, let's say 60, 65 basis points. And I think, oh yeah, the Bank of Japan will only interfere at 100. I might in for a bad surprise. Yeah, they just might act and have reserved that right now to actually, well, frighten the speculators a little bit again.
Correct. So effectively now they've gone back to not telling you where the band is, in my reading. It's not necessarily something they've said, but it talks about sort of, they refer to this thing as nimble activity, very sweet words from central bankers, but it shows you they're human, right? And now they are snipers. So you don't know where the snipers are. You try and do your trade at 65, and then suddenly they come in and they say, right, mine at 65, as many as you've got. And then yields go back down to 35. And there you are, you're coming home, you say, how did you do today, darling? Well, I lost money again on that trade that I tried 20 years ago. So it is a tweak to what they've been doing. And what is it coming back? What is it that they're trying to do? This whole policy is about keeping solvent their sovereign. And if their sovereign is going to get beaten up because they say 25 basis points and then people come in and beat them up, then they say, okay, 50. All right, we didn't mean 25, we now mean 50. Get beaten up. And then they do 75, they get beaten up. So now they say, we're not going to tell you where it is, but it's, definitely 100, you're toast. That's the electric fence. But in between there, we've got some snipers, we've got some mines, you decide where you want to tread. They need to maintain this thing as long as possible until they own enough where they just say, you know what, we don't care. We put the JGBs in the drawer. They owe us the money. We're not going to go and chase it. So
they move from honorable samurai stuff to tricky ninja shit.
Nice. Yeah. So possibly.
No, I have to admire that, yeah, because in my book, it's as well as in yours. Whenever somebody gives you a boundary or a border, where's the market going to go first? It's going to that boundary or border. So playing chicken now with the market, the first move I would expect, market goes up to 60, 65. People are getting speculators. are getting more and more confident in shorting JGBs, and then they rip their faces off in one big move, and then that was that for the first time. And they have established, we are still the big boys on the block. We have room. We still have a cap here at 1%. It's not getting more expensive for the Japanese state to refinance itself. We want a little bit of inflation. We got now a little bit of inflation. Great, because we were devastated by deflation for an eternity. So they achieved now what they wanted, and what is the implication then? Because I'm not an FX guy. What's the implication on the Japanese yen now after that move, if there is one?
So that is really the big question, because my view on the yen has been that there will be a repatriation of money from overseas back to Japan, because Japan has been for a while at least, the only country that's really shown in the developed world that's showing signs of growth. Now, obviously, we're seeing some growth numbers in the States. People are questioning them. Are they real? Are they not real? And Europe, you and I talk about Europe and saying, this is really a great place, to put your money. And, maybe the Japanese investors also think at the time, well, actually, maybe after 20 years, this is also not a bad time for us to reinvest in
well, we discussed it a couple of weeks back when we spoke about Japan, after I came across that beautiful chart deck from Schroders, which did a lot of fun. I'm going to put that video in the end card of this video, so you can reference to it again if you like to watch it again. But that was an interesting conversation. So, because from my take, did they put a floor underneath the yen at these levels at the moment?
No, because what the initial reaction from the market was... You
see me devastated again. I just thought I got it, and then you say
no. You're almost there. I mean, okay, so what actually happened at the time was the yen strengthened from, above 140 something down to around 138. So the initial reaction from the market was, oh, the Japanese have just put interest rates up to 1%. Wow. This is it. Rates are going up everywhere, and but Japan, this should be strengthening the yen. Okay, the yen strengthening is all about. So, firstly, what level does the yen represent? That if you overlay a chart of 10-year yields, US yields, it's fairly good correlation. So what that means is that if the yen stops going down and starts to rally, so to below 140, 138, 135, my view is it will, for all the reasons: growth, repatriation, etc. And plus, I think the other central banks will cease their rate hikes. But so if that happens, then effectively that itself puts a cap on international bond yields, in my view. So, but the fact that the yen is still weakening means that the market is not yet buying the idea that the interest rate differential is going to narrow again, so that the yields of Japan versus the yields of the States, if you're buying the yen, you're effectively saying, I think that differential will narrow. And the fact that the market has decided to sell the yen as a 142-ish today means that they still think that differential will widen. However, the Ministry of Finance, who are the arm of the government who are responsible for the currency, don't like the yen falling out of bed. They don't mind it gradually weakening, but they do mind it falling out of bed. And they may have, and I don't think they have announced, bans where they say, oh, if it goes above this level, we're going to come in. We know what the problem with bans are. So they may well jump in there. And as you say, they've got enough firepower. They've got enough treasuries to go and sell if they really wanted to. And the US also need to consider this thing, because the US right now are in their own yield curve control. I said that in the last video, where Janet Yellen is issuing lots of T-bills. Yep. She's not issuing coupon bonds. She's willing to pay 1.5% more on trillions of debt for the privilege of rolling it over in 6 months' time or a year's time, rather than borrowing in 10 years. Why is she doing that? She's doing that because she also understands the liquidity, and this is not going to be, very clever in terms of the stability of the US Treasury market. So she's issuing everything in the short end. if the yen starts to show weakness, there is a risk here that the Japanese again intervene. And where they're going to intervene, I'd do it where it hurts the most. I mean, if Powell does not stop his rhetoric of, higher for longer and all, we're going to keep going, then if I was the Bank of Japan governor, I'd be saying, okay, or Ministry of Finance, I'd be saying, okay, I think we need to intervene. Let's sell some 10 years or some 30 years. And let's shake it up a little bit.
Wouldn't that be nice? Powell doesn't have to hike anymore. The Japanese would do it for him.
Well, the Japanese can't afford to hike. And neither can
No, not in their currency. Simply by selling the shit out of the treasuries they have on.
I know, but
because that was one of the trades at the beginning of the year. I thought I had a quick tactical trade, went long the TLT, and honestly, I kid you not, the next day the bloody Bank of Japan came out and sold treasuries galore. So I was stopped out of that, and I thought if they wouldn't have come in, I would have made a nice buck for week time work, and then this happened. So I see the danger in here, but isn't that all? When you mentioned Yellen now, and aren't they already forecasting, coming back to my old topic, that there is a recession or something severer on the cards when you say, well, I'd rather spend now because refinancing in a couple of months' time will be far cheaper than it is now. And I already assume that's going to happen. Okay,
but by using the word recession, you are linking these markets to the economy. At the moment, the furthest I'd go at this stage is to say that the market it's a tinderbox. It could go at any moment if they cock it up, if they don't work together, these central banks, if the Bank of Japan won't do that. Why wouldn't they do that? Because if they sell the 10-year, if you think this through, the yields go up on treasuries, then the yen falls even more because the differential. Global rates go up. Volatility, move index we talked about is important for liquidity. They wouldn't do that. They have to work together. They have to actually cap rates. Yeah. There comes a point in time where the Americans and the European central banks have to stop this rate hike thing because it is not in their interest to destroy a very fragile system. This is we're talking about forest fires these days. This is what you've potentially got the equivalent of in the bond market, where it's just one little thing, one false move, and this whole thing could go and it's the risk-free asset theory. It's a lot of risk in that. It's the risk-free asset. If it goes, everything that sits above it, which is everything, goes. It can't go.
Don't we have the situation in Japan? Obviously not my line. I've stolen it, but I love it. A return-free asset, but with lots of risk.
Yes, this is absolutely correct. So, when you talk about sort of life cycle products and things like this, and you try to sort of de-risk your clients or these insurance companies, they try to, as people approach retirement, they put them into very low risk type investments. Well, these things are as risky as they've ever been, and this is not good. This is in a state where the sovereign's debt is so high, you have to be very clever, nimble, ninja. As the equivalent in America, you have to be as well with your policy. And, the Americans, in my view, and the Europeans as well, and the Bank of England as well. I mean, the three of them are all together. One does one and, the others copy. They have to be really damn careful because this game of chicken with the markets that they're playing is far, far too dangerous to get wrong. And they're sailing very close to that level, whatever that level is. We don't know, where things just basically break, where suddenly another bank goes and another bank goes and another this goes. You saw this trucking company that went under, maybe you did, maybe you didn't, over the weekend, 100-year-old trucking company in America going under. Things are not going good. Yeah.
So where's the trade for us, Nick? Because there's always, if something, and I think it is something monumental, if they've now decided, we're being ninjas again, and we're interfering in the market and keep the market on its toes, thinking in terms of volatility, thinking in terms of bonds, thinking in terms of currency. If you had to do something, where would your positioning be at the moment? Where would you try to extract money out of that situation? Or would you say there's a time for, how's it called, for buying, time for selling, and time to go fishing? Or golfing in your case? Is that golfing time?
Well, if you're going to, this is a really good question, because, I've been bullish on the Nikkei. I've not been bearish and still long of stocks, US, European, whatever. This is okay if you're already in. If you're not in, there's a real question when you get in, how nimble you've got to be, because you just, that's a really difficult thing. So I actually really like your suggestion from last week about, so it is possibly time to stick some cheap vol on the books, and whether that's long dated or not. I mean, I'm not the expert there, but you have to really think about this. I still believe in gold, but I wouldn't be putting new gold positions on at this level. I still believe in crypto, but I wouldn't be putting new crypto on at this level. And for that reason, and it's the same thing for these oil and copper markets. There's a level to buy them, and then there's a level to just sort of wait and watch. And when you're in this kind of mode, you just have to say, I talked about the point of recognition. The market suddenly realized things are going up. Well, it's okay for me, because I didn't get out in October. I wasn't short in October. I haven't been shorting all the way up. But for those people who suddenly realize, actually, I need to reverse my position, it's a very difficult thing to actually manage that risk in such an environment. And that's not very clever. And that's why what we try to do ultimately is keep you steered along the road as an advisor, and not to just say panic yourself and get in now because everything looks okay. It doesn't look okay. It looks exceptionally fragile, but it doesn't look like recession. Recession is the last thing I'm worried about. I mean, recession. If there's a recession, they do, they go and print some stuff. I mean, and then it's a shallow recession. Recession. I mean, do you honestly think that the governments will accept a recession? Of course they won't. Yeah, well, so recession is not what I'm worried about. I'm worried about the system breaking.
Yeah, well, that's exactly the point. Recession is not a biggie. And of course, governments don't want a recession or accept it, because that's bad for the voting public when you're in charge and you have a recession on the books. But we discussed that as well. There is this point when the market is just overwhelming, when everybody wants to go through that one door, and even central banks can't do anything against that. Sure. And you just mentioned it. The system is very fragile. It's very in an unstable equilibrium. It's the ball is on the top of this. It's not here where you would say, yeah, it goes left and it goes right and it will stabilize in the middle again. In my view, at the moment, we are balancing here on the top. So that's my, call it slight inclination to build up on volatility. I'm just wondering where the blow is coming from. Is it coming through international currency markets, or what we discussed, the credit markets? Are they going to give us the final push in a year's time when the refinancing starts? Or is it in 2 weeks' time when NVIDIA comes out and says, oh, by the way, no, we haven't made 8 billion and AI sucks?
Yeah, so that's also a really good question. So my fundamental kind of thesis has been that the system's not allowed to break. But the Fed are doing really not favors to, because they're really pushing this thing, I think, very, very close to the point where things might just break. So, but if the thesis is right, the trades will be right, and the trades would be the dollar weakens because the world functions better with a weaker dollar. With a stronger dollar, the world does not function, right? I mean, it gets worse, and I wouldn't say that we've got a healthy growth in the world. So that's the first thing. So the dollar's got to weaken. The places I would rather be, or the investments I would rather have at this time, you said, what's the trade? The trade is having the right portfolio. And the right portfolio, was, short dated government bonds. It was, gold and Bitcoin. It was risk assets, but preference for emerging markets and Asia, right? So that includes Nikkei. And it's potentially even Hong Kong and China right now, because the Chinese made a statement which was quite fascinating a couple of weeks back. No, less than a couple of weeks ago. Again, a note from Paul Covey. Good. These are good analysts. He said something, picked up on 3 words that the Chinese said, effectively that real estate is not a speculative asset anymore. So that was what they said last year, and the real estate market was tanking. Now they've taken it out, which means that they're willing to support the real estate market in theory. So therefore, potentially now the Asian thing is China as well.
So they've taken the heat off. I've noticed that as well last week. When suddenly, but if I look at that from a different angle, doesn't that also mean the water is already just here in China? If they say, if we can't get our real estate market under control and invigorating growth there, we're on a real pickle here. So the opposite actually to saying, oh yeah, China will finally reopen and everything will be fine and risk will be allocated. And we see fantastic growth rates, which are faked anyway, I assume. Yeah, nobody knows what that 6% GDP growth. Where on earth are they pulling these figures out? Yeah, it's always this, but people are eating it up. And when I hear then, yeah, no, okay, we are not going after our real estate providers anymore. That pretty much sounds to me like the financial crisis, when we said to the banks, you know what? Yes, we're TARP asset relief program, and just put them in at face value, and we don't want anybody else to blow up. And then you still had this phase of it first has to boil down a little bit.
Sure. I mean, the question is, if you look at the analogy of 2008, 2009, you know, the blow up was last year. So are we at the end of 08, where March 2009 was actually the start of the rally and the low? So are we at that point? Or are we at the point of 2007, where we're still coming into this thing? And I would say that's why, you know, the preference on the asset allocation would be, the areas where I have most concern are those people who haven't actually blown up anything yet, where they are doing their desperate attempt to blow things up. And I would rather sort of go into this Asian market, and well, we are. So we've been recommending that, and emerging markets in Asia, and we've been there, and you know, been patiently on that, and LATAM and so on. But the Western markets are, you know, question mark, I would say, and the bond markets, you know, you keep pushing me on that one. There was a point in the year where I said, oh yeah, 10-year, you know, you're going to get yields down to about 3.5%. I'd say that's possible as a trade, but you know, these guys are screwing things up so much. I really don't know.
You just mentioned the emerging markets. That's why I'm staring into the infinity at the moment. I put up a slide in front of me when we were talking about debt to GDP ratio in Japan. And they're obviously also the emerging markets, and they've split it also in household income or household indebtedness. And that's actually quite interesting, because you see the green dots in places like, of all in the developed world, Italy, only 42%. And then places like Brazil, 32, India, 39, Indonesia, 16, Mexico, 16, and Russian Federation, 20. That actually made me think to say, yeah, fine. What do people like? They like people who do not have already too much debt, who can take fresh money on, who are at the bottom of the pile. Yeah? Nobody's given them ever any money, so there is potential for growth. That's an interesting way of looking at it.
I mean, obviously, I'm far too early for that call, and early means wrong in our world. But you know, the point I made to my clients is that you know, emerging doesn't have a sovereign problem really. I mean, Turkey does. You know, so a few places do, but even Turkey is now interesting in my view. Yeah, and you know, forever, I don't think I've ever been interested in Turkey. I'm potentially interested in Turkey now. I don't see the turn yet. But it's on the radar, and you know, it really makes me think about where the right asset allocation is. And for everyone who have their investment committees, and they, you know, say, oh, should we do more Germany, or should we go back into the States, or should we do NASDAQ? And it's the same old thing that you juggle around. You think, well, hang on a minute, you're missing a part of the world that it's the BRICS, right? They are potentially a very, very interesting space, and you need to think about that as a much bigger asset allocation, because they don't have as big a problem as these others.
Yeah. It's time that we need to get a couple of new narratives introduced in our discussions, because it's getting boring now. Yeah, we're talking all about the same stuff over and over again. And that is, how many years ago is that? Almost 20 years ago, even longer, when the Tiger States, no, it was in the late 90s. Yeah. that was a nice conversation to have. We saw growth, people were happy. Yes, obviously it ended in tears, but this narrative hasn't been on the books since forever. So I think that is an interesting region to look at, especially if I could find my one little trigger point, like what I mentioned now, you know, these little details which find my interest to say, well, they are not completely indebted. As you said, sovereign debt is no problem for them at all because, well, they have already gone broke, so it's fine. Yeah, they start from a clean sheet. Nick, on this point, we'll have to cut it short today a little bit. And I started as an explainer. Thank you very much for explaining a lot of things to me. I almost thought I got the yen thing right, but then I didn't. But then I got it again right. So thank you for that. And the week after, you are going to see that now to the audience. Nick and I will be live again on a Sunday to see what happened during the week. Nick, thank you very much. Again, last final words.
Enjoy your trip to London.
I shall. Thank you very much. Hope you are enjoying our little conversations, even if we've been a little bit shorter today. And yeah, thank you, Nick. Thank you all for watching. Like us, subscribe, and comment. Bye.
See you. Bye-bye.